So I'm Salman Tajamal. I'm the team lead of the registration group at the ASC. And due to popular demand, I'll be covering registration requirements for advising reps and associate advising reps. Specifically, I'll be getting into requirements for relevant investment management experience, or RIME for short, and how we assess this criteria. I recognize that these terms, advising rep, associate advising rep, are not commonly used terms in the industry. I've more so heard terms like investment counselor, portfolio manager, and so on, but because we're talking about regulatory requirements, I'm going to stick to using advising rep and associate advising rep. This presentation is most relevant to portfolio managers, in particular those that are looking to onboard ARs and AARs onto their teams or looking to graduate AARs to ARs. It does not cover restricted portfolio managers and the individual categories associated under that registration. So speaking of PMs, ARs, AARs, I want to clarify that there are sort of two layers to the registration regime. There's firm level registration and individual level registration. So at the firm level, you have categories like portfolio manager, and then at the individual level, there's AR and AAR, where PMs are sponsoring these individuals. So this presentation is focused on the individual level at ARs and AARs. But in the next presentation, my colleague Raymond is going to be talking about client relationship manager, CRM ARs, so stick around for that. Okay, this is the agenda for today. I'll start with discussing RIME requirements in general and then get into how they apply to AR and AAR registration. I'll go through some common questions that we've received with respect to registration in these categories, and then finally run through some actual applications, examples of submissions that we've reviewed and approved or not approved. So before I launch into the presentation, I want to kind of emphasize that I'll be using a lot of acronyms, especially RIME, AR, AAR. And because this presentation and the next one is going to be referring to these acronyms quite frequently, I want to make sure that everyone knows that RIME is relevant investment management experience, AR is advising rep, and AAR is associate advising rep. Okay, let's talk about RIME requirements in general. They are described in the companion policy to 31-103, and they include researching and analyzing securities for inclusion in fund or client portfolios, or it's portfolio management on a discretionary basis, which includes investment management and rebalancing. So note the term "or" here. It's not an "and." The ASC accepts experience in either one of these categories or criteria. We have reviewed and approved several submissions where experience was demonstrated in only one of these criteria and not both. There is quite a bit to unpack with this definition of RIME, but in general, there are three key elements to keep in mind, and they are that RIME must be securities related. It has to be customized to a fund or a client portfolio, and it cannot be general in scope. I think the most effective way to get into RIME or describe RIME is under in the context of AR and AAR registration. So let's start with AR registration. The AR category has the most advanced proficiency requirements of any individual registration category, and it's dependent on two components, which are education and RIME. The requirements are covered in Section 3.11 of National Instrument 31-103. There are two pathways to become an AR. The first is to have a CFA and 12 months of RIME, and these 12 months have to be within 36 months of applying for registration. This is just to ensure that relevant experience is current. And the second pathway to become an AR is to have the CIM designation and 48 months of RIME, but 12 months of those have to be within 36 months before applying for registration. Okay, getting into AR RIME. You may recall from the earlier slide that AR RIME generally consists of either researching and analyzing securities or discretionary portfolio management. So this slide covers research and analysis, and then the next one will cover PM activities. So the key with research and analysis is that it has to be tailored to not only securities, but also to a client portfolio or a fund. It cannot be general in scope. This slide lists some examples of how AR RIME can be gained. They include fundamental analysis, such as estimating whether a security is overpriced or underpriced or at par in comparison to its intrinsic value, estimating future earnings potential, comparing quantitative measures and ratios, or just doing like a top-down analysis, a macro analysis, or a bottom-up approach. AR RIME can also be achieved through technical analysis, such as analyzing statistical trends or analyzing charts to identify price patterns. AR RIME can also be gained through analyzing correlation and risk of securities in portfolios. And the example that comes to mind is to what degree would adding a particular bond to a portfolio increase diversification in that portfolio if the portfolio was made up entirely of equities? Okay, moving on. AR RIME can also be achieved through discretionary portfolio management. So we find that this type of experience is generally gained by AARs under the supervision of an AR that's performing PM activities. But we've also seen this experience gained through registered reps. So these are reps that are registered with CIRO or formerly IROC, and they have PM discretion. And we've also seen it achieved through by investment professionals who manage portfolios in-house, such as pension and corporate treasury portfolios. Some further examples are included in this slide. So in the context of client portfolios, AR RIME can be gained through drafting an investment policy statement and determining asset allocation, recommending securities or rebalancing portfolios, or creating and rebalancing model portfolios. So note that this is not just simply that last sub-bullet point there on creating and rebalancing. It's not just simply placing clients in model portfolios, but it's the creating and rebalancing aspect that achieves the higher level of RIME required for AR registration. In the context of funds, AR RIME can be achieved by drafting fund mandates and determining asset allocation, or through determining suitability of investments for inclusion in a fund. So as with the research and analysis piece, the key in these examples is that the PM activities have to be tailored to a client portfolio or a fund. It cannot just be general in scope. Okay, moving on to AAR registration. These requirements are covered in section 3.12 of NI 31-103. And the eligibility requirements for an AAR, it consists of two components. There's the education piece, which is either the CIM designation or level 1 of the CFA. And then there's RIME itself, which is 24 months of RIME. But unlike the AR category, these 24 months of RIME can be achieved at any time before applying for registration. you're not subject to that time limitation as you are with the AR category. When it comes to AAR rhyme, and unlike the AR category, there is less emphasis on fund-focused or client-focused portfolio management or research and analysis. There are more ways to gain AAR rhyme, and when we receive such applications, we tend to assess them on a case-by-case basis. Some examples of how AAR rhyme can be achieved are listed in the slide here. They include client relationship management, so that would be things like assisting an AR with portfolio management functions like drafting an IPS or determining asset allocation. It can also be achieved by, for example, monitoring security positions to determine whether they're within target ranges. AAR rhyme can also be gained through corporate finance experience related to securities. So for example, debt or equity financing or mergers and acquisitions, such that this experience demonstrates an ability in an understanding of securities. AAR rhyme can also be obtained through registration as a registered representative with CIRO, formerly IROC. If that rhyme demonstrates an ability in or understanding of securities with client-specific investment recommendations. So for example, CIRO reps that are offering placing clients in model portfolios, they can be eligible for AAR registration if they also show some sort of investment management functions, for example, assessing KYC or assessing suitability and making, determining risk tolerance and unique circumstances of a client. Okay, the next 3 slides go through some common questions that we've received for AR and AAR registration. The first question here is, can rhyme for ARs and AARs be acquired outside of traditional PM activities? Short answer is yes. Rhyme is not just limited to individuals that are stock picking or performing traditional client-facing PM activities. As mentioned in an earlier slide, it can be gained through fund management, drafting fund mandates, or determining asset allocation of a fund. It can also be gained through performing know your product KYP type due diligence to assess whether securities should be included on a firm's product shelf. Okay, next question. Does recommending model portfolios satisfy AR rhyme? I think solely recommending pre-packaged model portfolios does not meet the threshold for AR rhyme. We would look for other investment management experience, such as drafting an IPS, determining asset allocation. This would be needed to supplement the placing clients in model portfolio experience. And if such experience does not exist, then we think that AAR registration would be the way to go. Can an individual qualify for AR registration without prior AAR registration? It's possible, but it's really rare for us to encounter situations where an applicant does not have any prior AAR experience unless that experience is research and analysis based, or it's experience in managing an in-house treasury portfolio or a pension fund or something similar. So because of this, if there is an individual in your firm that is assisting or helping to perform PM activities, and they meet the requirements for AAR rhyme, then we encourage that person to seek AAR registration so that they can start gaining RIME credits rather than waiting for later for them to apply directly to AR. Okay, next question. What type of securities meet RIME requirements for ARs and AARs? Based on my experience, there is a misunderstanding or a misconception that only publicly traded equities and fixed income meet RIME requirements, but this is inaccurate. Other securities that we consider as meeting the RIME requirements include ETFs, mutual funds, derivatives, exempt market securities, and non-publicly traded funds such as LP units or MIC fund units. Next question, is foreign experience considered for RIME? The short answer is yes. The reason is that securities legislation and guidance do not distinguish between foreign versus Canadian experience. Okay, last couple of questions here. Are reference materials, for example, reference letters, required from former employers to substantiate RIME? No, they are not. We are aware of confidentiality concerns and sensitivities regarding, asking a person to contact a former employer for reference materials, including reference letters. So when we get registration applications, we always ask for a description of RIME. And then we follow up with an applicant to clarify certain things. We actually might also interview the applicant to seek that clarification. And it's only really as a last resort, a last option, and that too, it's on a voluntary basis that we ask for a reference letter from a former employer. And that typically only happens in situations where the the RIME in general being described does not align with the former firm's business model. And I can say that sort of in the 2+ years that I've been involved in the registration group, we have not asked for a reference letter or reference materials. We generally go by the description of RIME. Okay, next question. How long does it take to review a new registration application? So a little bit of background on this, that individual applications from PM firms, especially in the AR category, require the most scrutiny because they have the most advanced proficiency requirements for registration. So it's a bit of a trade-off. There's a lot of scrutiny at the registration stage, but then post-registration, an AR has the most flexibility when it comes to managing client assets and performing PM functions. So what we find can expedite the process is to provide us with 2-3 solid examples of RIME. That reduces the back and forth with firms, and it helps us along our way. Based on long-term averages, we're taking about 25 calendar days to complete applications for ARs and AARs. And that is longer than our internal 10-day benchmark for other types of applications and submissions. And the reason is just because of the complexity involved with AR and AAR applications. Okay, last couple of slides here go through some actual applications that we've received for AR and AAR registration. So in this first example here, prior to applying for AR registration, the individual had a CFA. His experience was geared towards research and analysis. So to be specific, this individual had 9 years of research and analysis with specific fixed income products. 2.5 of those years were as an AAR. And this person was making recommendations to ARs for inclusion in client portfolios based on the research analysis being conducted. This individual didn't have your traditional client-facing PM activities like collecting KYC or drafting an IPS, but we found that the research and analysis was sufficient, and this person was registered as an AR. Next example here of an AR application. This individual had a CFA. She was in a client relationship manager role, a CRM AR for 1 year. This was her most recent experience. And in this role, she had been performing PM functions, so recommending model portfolios, assisting ARs with drafting an IPS, and so on. Prior to the CRM AR experience, she had 4 years of RIME in an AAR capacity. And we found all of this experience to be sufficient to meet the AR requirements, and she was approved. Last slide here, and there's a couple of AAR examples. In this first one, we had an individual apply for AAR, and the individual had a CFA. He also had extensive experience, over 10 years of performing technical analysis, which was gained at a non-registered entity. So what was happening is PM firms would hire this entity to perform specific analysis on securities and for looking for an opinion on whether to buy, hold, or sell the security. This individual had developed investment tools and had used those tools to model security price projections. We found this technical analysis experience sufficient for RIME, and the individual was approved as an AAR. Last example here. This individual had a CIM designation and had about 5 years of sales experience. So 2 years with the title VP Sales and another 3 years as a business development manager. So as these titles suggest, the roles were sales-oriented. Specifically, they were about the individual helping ARs with prospecting clients and also determining which markets the PM firm should expand into. So we found that AAR RIME was not being met. We let the firm know. The firm understood, and they withdrew the application and decided that the individual can gain RIME through his current EMD dealing registration, meaning that he would use his EMDDR registration to collect and assess KYC, perform a suitability analysis, and make investment recommendations. And that concludes the presentation.
Good afternoon, everyone. My name is Raymond Crasto, and I'm a senior registration analyst at the ASC with the registration team. My team specializes in assessing and approving individual registration applications across all registration categories, including portfolio manager advising representatives. In this presentation, I'll be covering the registration requirements for client relationship manager advising representatives and some of the restrictions associated with this category. The agenda will cover the following topics: proficiency requirements, types of activities conducted by client relationship manager advising representatives, also referred to as CRM ARs, restrictions associated with this category, and some of the common questions asked. Before I continue, let me go over briefly as to how the CRM AR category came into effect. Portfolio manager firms may choose to use an operating model that divides responsibility amongst their registered individuals. For example, One group of ARs will handle the selection of securities in clients' managed accounts, for example, by creating, managing, and rebalancing model portfolios used by the firm, while another group of ARs will act as client relationship managers, working directly with clients, not having to select securities for client portfolios, but rather placing clients in the firm's model portfolio. In order to facilitate this type of operating models, the CSA introduced CRM AR category in June of 2020, wherein qualified individuals who did not have sufficient relevant investment management experience to register as an AR, register as a CRM AR, so that they can perform similar activities as that of an AR, with the exception of security selection. We have noticed that this is not the most common category amongst smaller PMs, and is a category that is typically availed of by larger PMs that have structured its business to make a clear distinction between client-facing roles and security selection roles. Nevertheless, CRM AR category is available to individuals sponsored by all portfolio manager firms. Moving on to the education and proficiency requirement. The proficiency requirement for CRM ARs is similar to that of an AR discussed in the earlier presentation by Salman. Individuals applying as CRM ARs are still required to meet the AR requirement under 31-103, section 3.11, that is to have the CFA or the CIM designation. The relevant investment management experience discussed in the earlier presentation applies to the registration of CRM AR, with the exception of security selection experience. In simple terms, specific security selection experience is not required to meet the CRM AR experience requirement. This means that qualified individuals can register as CRM ARs if they generally have experience from having been a registrant who performed investment management activities such as collecting client information, recommending securities, and rebalancing portfolio. Or if they have gained experience from assisting registered advising representatives in assessing suitability, determining asset allocation, drafting investment policy statements, monitoring client portfolio, and performing research and analysis on the economy or asset classes generally. Let's take a look at the activities typically conducted by CRM ARs in a client-facing setup. CRM ARs may formulate and draft the investment policy statements for clients. CRM ARs may design the asset mix for clients' tailored portfolio. However, then steps back while an unrestricted AR selects specific security that fills in each asset class. CRM ARs may recommend model portfolio or pooled funds that have been designed and are managed by an unrestricted AR. And CRM ARs may complete trades to implement a model portfolio asset allocation or to rebalance an allocation that has been previously approved by an unrestricted AR. These are some of the activities CRM ARs can conduct with the pre-approval or supervision of an unrestricted AR. CRM ARs can analyze securities for a client but may not advise on individual securities for inclusion in a client portfolio without having this advice pre-approved by an unrestricted AR. CRM ARs may collaborate with a team to design the model portfolio and provide views on the potential security choices to be included. The important point to note over here is that the final decision on selecting the specific securities is made by an unrestricted AR. I will move on to discuss the category restrictions, terms, and conditions associated with CRM ARs. Onto the National Registration Database, also referred to as the NRD system. There isn't a separate category created for CRM AR. The two categories, CRM AR and AR, are distinguished by category restrictions, terms, and conditions. These terms and conditions are also available onto the National Registration Search or the NRS website. The CRM AR terms and conditions highlight 5 key sections. The first terms and condition is no advice related to selection of individual securities. As covered in the previous slides, CRM ARs cannot provide advice on individual securities for inclusion in a client portfolio on their own. They can only do this if the advice has been pre-approved by an unrestricted AR. The second terms and condition is activities requiring approval of an AR. So when the advice was previously given or approved by an unrestricted AR, CRM ARs may communicate with clients on the investment recommendation in individual securities. CRM ARs may direct trades in individual securities to implement asset allocation decisions and account rebalancing. An example to this would be model portfolio. The third terms and condition is CRM AR review and approval of advice provided by an associate advising representative. CRM ARs may not review or approve advice provided by an AAR concerning the securities of any specific issuer. CRM AR can approve AAR recommendation of model portfolio and pool funds that are designed by an unrestricted AR. And CRM ARs can approve asset allocation and investment policy statements drafted by an AAR. The fourth terms and condition is written disclosure of advice restrictions to clients. So CRM AR should provide clients with a written plain language explanation about the limited advising activities that the individual is permitted to perform as a result of these terms and conditions. And the fifth terms and condition is no misleading use of titles, which we will discuss in the next slide. So CRM ARs must refer to themselves as client relationship managers in all communications to clients and marketing materials. This includes business cards and email signatures, and may not use any other title that may imply that the individual can conduct advising activities without any restrictions. On the screen, you can see 2 examples. The first example, Wealth Advisor, Client Relationship Manager. This is an acceptable title because it implies a broad role that does not necessarily involve providing advice on specific securities to clients. The second example is Investment Counselor. This is not an appropriate title for a CRM AR because it could be interpreted by a reasonable client to imply that the individual gives advice about specific securities. With this, we're going to go over some of the common questions that we have received. The first question is, can CRM AR registration lead to future unrestricted AR registration? And the answer to this is possibly. This depends on the experience gained by the individual as a CRM AR. As Salman discussed in his presentation earlier, RIME for an AR includes research and analyzing securities for inclusion in fund or client portfolio, or portfolio management on a discretionary basis. So if the CRM AR conducts research of securities and recommend them to be added to model portfolio, subject to AR supervision, they could eventually gain enough RIME to become ARs. Likewise, if they recommend individual security when their advice is pre-approved by an AR, then such experience can also assist in terms of registering as an AR. The next question we have is, the terms and conditions applicable state that CRM ARs need to inform their clients about their limited registration as ARs. Can this be done verbally? The answer to this is, while clients can be told verbally about the CRM AR role at the time that they are assigned to a client account, they must be informed in writing, such as part of the relationship disclosure information under section 14.2 of 31103. The disclosure should be specific enough in nature that each client understands what their CRM AR is permitted to do. The next question we have is, can a firm request changes to the CRM AR terms and conditions? The answer to this is no. These are standard CSE approved terms and conditions that cannot be amended, so a level playing field applies to all CRM ARs in Canada. Firms that are considering any changes to the standard CRM AR conditions would need to submit an exemptive relief application pertaining to their business model and how CRM ARs fit into this. For example, if a firm only deals with permitted non-individual clients and not retail clients, then a firm may request certain variations. Exemptive relief application is subject to a comprehensive review by the ASC staff and may not be approved.
That's it for registrations group. We have registrant oversight now for a little bit. Although yesterday in Calgary, all the questions related to this presentation were registration in nature, so you may hear from them again. Good afternoon, and I think I know some tables, not everyone, so come pull my hair and meet me if you don't know me. Be nice to meet you after this. My presentation today is somewhat brief, but it's an important topic, and although it's aimed kind of foremost at smaller and sole proprietor firms, it is relevant to all firms. For some of you, your firm may already be mostly or fully prepared. However, for others, and in particular for those smaller and sole proprietor firms, this issue can pose some challenges, but it is an issue that needs to be addressed. So I'm speaking about both sides: business continuity and succession planning. And I guess this afternoon I'll explain what the challenge can be for the smaller and sole proprietor firm and why it's a regulatory concern. I've included a slide with references to some guidance to help you think this through. And I'll also discuss recent steps taken by registrant oversight staff at the ASC in an effort to assist. So, a couple dryish ones here, but then they'll be done. Business continuity, succession planning, what is it? It's a need for policies and procedures to protect or mitigate, respond to, and recover, let's go with that, from business interruptions and other disturbances that may disrupt your business and the firm's operations from day to day. So it includes procedures to protect, back up, and recover the firm's books and records, perhaps as a result of a cyber incident or natural disaster. And it also includes a plan for the relocation of the firm's offices in the event of temporary or permanent loss of either the firm's head office or other places of business. For some, I guess your continuity plans were tested in this respect in 2013 floods or in more recent forest fires throughout Alberta. And for many of you, COVID, of course, challenged your policies and procedures, your abilities to navigate uncertainty in the changing landscape at that time in kind of dealing with your clients, your operations, and your service providers. Business continuity and succession planning, it's also about the need to ensure that your firm is able to manage the impact to your clients and your operations in the event of death, incapacitation, or a prolonged absence of key individuals at your firm. And it's this latter element of business interruption and succession planning that is the focus of my talk, and the emphasis will be on regulatory concerns and business implications faced by those smaller and proprietor firms, so such as the one or a few registered representatives firms with those. Okay, so firms required to have and apply policies and procedures that establish a system of controls sufficient to ensure compliance with securities legislation and to manage the risks associated with your business. So the companion policy to 31103 specifically notes that the risks related to business interruption are among the risks that need to be considered. In 2017, the CSA published Staff Notice 31350, which communicated observations identified during compliance reviews conducted of small registered firms. And it provided guidance to assist these firms in meeting their regulatory requirements. So a common deficiency identified across registrants was in the area of business interruption and succession planning. In particular, it was found that 35% of firms either did not have a plan in place or had a plan that was inadequate. In more recently conducted ASC compliance reviews, we continue to see firms with plans that do not address business continuity and succession planning in the event of key person loss. As one way for small firms to manage these risks, Staff Notice 31350 outlines the concept of designating a BCP executor to carry out the firm's business continuity plans. That publication also includes a list of items for firms to consider when developing a BCP, as well as when working with an external BCP executor. For those of you at smaller firms, you'll recall an email blast was circulated by the ASC earlier this year specific to this topic, and that email reminded smaller firms that all registered firms are required to have a BCP to adequately manage the impact to clients and business operations should something happen to key individuals. Yeah, Nicholas.
Hey, sorry, I may have missed this start. What's classifying as small firm?
Either so a few registered representatives, or in particular a sole proprietor, is where some of the issues come to play. Good. So yeah, kind of bottom line of this is that all firms need procedures to respond to business interruption. So either procedures to ensure kind of day-to-day activities can continue, or procedures to wind down the firm. And a key consideration of this is ensuring that client accounts, including assets held in investment funds, can continue to be serviced by an appropriately registered individual. To better explain our concerns and why this matters to you, let's consider what this looks like depending on your firm's category of registration. So starting with an EMD with a sole registered individual. So in this case, from a regulatory standpoint, the potential outcomes are relatively straightforward. Absent a DR to continue to deal with clients, deals naturally will stop. An EMD may stop dealing new securities for a period of time, a few weeks, let's say, and then quickly resume its activities. And in cases where no registered individuals are available for the long term, for firms with a transactional relationship, while nothing further is required in respect of ongoing communication with clients, the firm may choose a BCP executor who will inform clients of developments and remind them to contact the issuers of the securities they purchased through the firm with any questions or for redemption-related queries. In the case of an EMD with an ongoing relationship with its clients, the BCP executor may also advise clients that the firm will no longer provide client statements because it is winding down, and instruct clients that the issuer may provide those statements or related information going forward. The EMD's BCP also must set out who will notify the ASC to update the firm's records and to initiate the surrender process, or to make the appropriate filings if a firm's being sold. So once a firm starts that surrender process, all ongoing filings to the ASC, financial statements, let's say, are still required. So next, look at a PM with the sole registered individual. And so we can understand that this example also applies to an RPM. And for reference here, the example I'll describe is in Staff Notice 31350. However, I'll mention a few nuances that can complicate how firms are able to meet the requirements which aren't addressed in that Staff Notice. So if a sole advising representative at a PM firm is no longer able to perform their registrable duties, client portfolios can no longer be managed by that firm unless the firm is able to register another AR. If the firm is unable to register another AR, our expectation is that the firm would promptly advise its clients of this fact and instruct them to engage another PM to manage their portfolio. And depending on the type of assets held by the client, this change in PM firm can be relatively simple, such as if the client accounts are held by a zero broker and custodian, or more difficult if those are in fact liquid or illiquid securities. Regardless, in most cases of business interruption, there's a period when the client's portfolio is not being managed, which could be a significant issue for clients who need to generate income to meet their cash flow needs, or who have a significant change in their circumstances requiring changes to their portfolio or a liquidity event. So unlike the exempt market, where securities are often infrequently priced and illiquid, client portfolios of liquid securities are at higher risk if unmanaged, especially in periods of volatile markets. So as a result, business continuity planning is particularly important for those small firms that manage client portfolios. A PM's or PM firm's BCP must also set out who will notify the ASC to update the firm's records and initiate the surrender process. In the event that the BCP executive decides to sell the firm, the appropriate filings must be made quickly in this case, since client portfolios cannot be left unmanaged. In this case, a best practice would be to have a prearranged buyer who is appropriately registered in a PM category in order to minimize downtime. And again, unless a firm starts the surrender process, all ongoing filings to the ASC are still required. In Alberta, so we also have firms registered in the PM and IFM categories that operate with the sole registered individual. So these firms have clients that are invested in funds or pooled funds through trust units or shares, which cannot, because of the structure, be easily liquidated without a registered PM for that fund that's appointed by the IFM. So an important consideration here is that should something happen to a firm's sole registered individual or registered individuals, succession responsibilities may be left to the surviving owners or directors of the company, so including family or loved ones that may know very little about the business and the regulatory requirements. If the firm and the fund have a surviving officer or director, then that individual can promptly appoint a new PM and IFM to manage the assets of the investment trust or to liquidate. So while PM activities cannot be delegated to unregistered individuals, and a new PM is or must be appointed for a fund, it's also possible for an IFM to outsource functions such as NAV calculations, trust accounting, and other fund accounting. Can outsource those to qualified third parties, and that's particularly helpful, or can be particularly helpful in short-term situations when a fund is in the process of being wound down. So if a impacted firm does not promptly appoint a PM IFM or quickly sell to another qualified PM IFM, then client portfolios effectively are inaccessible to clients, right? And not being managed, which could require the ASC to take regulatory action and petition the courts to have a receiver appointed, who in turn would select a duly registered firm from a list of applicants to wind down the fund or to continue to manage it. And well, it's a last resort given the risks faced by clients and the time-sensitive nature of this. it is a possible outcome should something happen to a firm's registered individuals without a succession plan in place that's ready to go. And of course, there have been instances in Canadian jurisdictions where where the death of a sole proprietor required this sort of regulatory intervention. Adam mentioned Trainer Ridge at the beginning, and there have been others as well. Because we recognize this can be a complicated matter with important business implications, the ASC has taken some recent steps in an attempt to help firms be better prepared. What we've done specifically, and just to be clear, this is just one option available to consider, is that we've contacted a number of Alberta-based PM, IFM firms to see if they were willing to discuss with other firms that are in need of planning in this area. See if they'll have a discussion with those firms, possibly be appointed as a backup or emergency PM in the event they're unable to perform their own registral duties. So a number of firms have allowed us to share their contact information, and the approach we've taken with this is to share that information of those firms willing to discuss with the firms in need, and we've left it to the firms in need to contact and reach out should they choose to do so. So our hope is that it'll help. We're certainly here, ASC-wise, to provide whatever level of guidance we can, especially in respect of regulatory landscape and requirements in this area. For example, there's circumstances where exemptive relief may be granted to assist firms in implementing the BCP. So, for instance, while there's a restriction on acting for another firm set out in the rules, maybe in two places at once sort of thing, we're prepared to consider on a case-by-case basis applications for exemptive relief from that restriction, and to do so on an expedited basis. So, not quite yet, but my hope, I guess, then is so that each of you or your firms can carefully consider if you have a plan in place that's sound here, or if you do, that's excellent, right? And if you're also willing to be available to any other firms, or at least speak with them, then you can certainly let me know offline, if not now, offline, and we can discuss that. And if you're on the other end, sitting there thinking that maybe your firm does not quite yet have a plan in place that is going to address this, and you'd like to speak with those firms, I'm willing to reach out, then also reach me, and I can put you in touch with a list of firms, and you can have that conversation. I guess I'll leave it there.
Hello, everyone. Welcome back. I hope you had a good break, and I hope you got some coffee. We'll start the next presentation. Hello, my name is Al Zahir. Along with my colleague James Steele, we will be presenting an overview of recent findings from ASC Registrant Oversight Compliance Reviews. As of December 31st, 2021, the second phase of the client-focused reforms to NI 31-103 became a requirement. These reforms involve updates to Know Your Client, Know Your Product, and suitability requirements. As Adam mentioned, the majority of our compliance reviews over the last year have focused on both these amendments and portfolio management firms. So this presentation may appear to focus on the CFR amendments. However, the intent is to provide you with an overview of the findings, which include other non-CFR specific findings that have been identified in recent compliance reviews. We've identified issues with KYC in multiple reviews. We note that some of these findings are not specifically related to the CFR enhancements, however, they are highlighted as they have been repeatedly identified. For example, registrants are not collecting risk capacity and risk tolerance consistently. Risk capacity is an assessment by the registrant of the client's financial ability to withstand losses, given the client's financial circumstances, assets, and investment portfolio. This is separate from risk tolerance, where the clients self-report their willingness to take on risk and uncertainty. Combined risk capacity and risk tolerance provide the client's risk profile. Staff have identified some instances where KYC forms have not been updated to collect risk capacity information. A definition clearly explaining the differences between risk capacity and risk tolerance has not been provided to clients. And advising representatives have not maintained adequate notes to document their risk profile discussions with clients. Staff also identified some registrants were not adequately collecting the client's financial circumstances. Specifically, they were not collecting the liquidity needs of the client. The companion policy to 31103 advises that registrants should consider the extent to which clients may need to access their investments to meet expenses and obligations, and whether the client has additional sources of income to cover these obligations. Registrants should ensure that when collecting this information, it be clearly identified as per client or per household, as this can materially impact the liquidity or concentration assessment. We also identified issues with KYC information collected when dealers relied on a prospectus exemption, particularly the OM exemption. In these cases, supervisory reviews should ensure that the exemption being used aligns with the information collected in the KYC. If registrants are relying on third-party algorithmic or behavioral questionnaires, they remain responsible for testing a sample of the KYC results collected from clients to ensure the required information is accurately being captured. For example, the weighing of risk capacity and risk tolerance questions when determining risk profile should reflect the lower of each response to ensure the client does not take on more risk than their risk profile indicates. With the CFR enhancements, registrants are now required to update KYC forms whenever the registrant becomes aware of a material change. Additionally, KYCs must be reviewed and updated if required, at a minimum of once every 12 months for managed accounts, and for exempt market dealers within 12 months before making a trade for or recommending a trade to the client. For EMD clients with an ongoing relationship where the client keeps an active account with the EMD, as a best practice, KYC should be reviewed, but not necessarily updated annually to confirm there have been no material changes if there are no new trades. We note that for EMDs who are not registered in any other category and selling a one-time exempt product, it is expected that a KYC was completed within the previous 12 months. However, there is no requirement to update the KYC again if it was a one-time exempt product transaction, and there is no ongoing client relationship. This is because KYC updates are required when the client has an ongoing account with the firm, and this is not the case in transactional client relationships for EMDs. Where KYCs are reviewed and there are no material updates, client notes should capture what was discussed with the client, leading to the conclusion that no update is required. Short comments such as no update and no changes are not sufficient to document that an appropriate discussion was held. A best practice would be to maintain a record tracking attempts to contact the client to update their KYC information, where clients are not responsive in updating their KYC information within the required time frame. Further, registrants should consider processes on what to do when KYC information becomes increasingly stale-dated, such as limiting investment actions. Staff have identified issues with their registrants' abilities to meet the CFR enhancements regarding KYP. A common finding is that registrants have not defined what a significant change for a product is. This varies based on the business model of the firm, the types of products and securities offered by the firm, the proficiency of its registered individuals, and the nature of the relationship the firm and its registered individuals have with clients. Once adequate criteria is defined, registrants must put into place policies to monitor their product shelf for these significant changes. Significant changes can include, but are not limited to, changes to product risk rating, changes to fees and costs, and any liquidity events. Registrants should review these significant changes as they impact client portfolios and may place the account offside for suitability. As significant changes monitoring is highly tailored to each individual registered firm, we expect registrants to create, follow, and document their own selected monitoring processes. We have identified several instances where there is no evidence of KYP having been conducted. Also where there is limited or inadequate evidence of KYP conducted and of the product being approved. All products being offered to clients or being included in client portfolios must be reviewed and approved by the registrants and evidence of approval maintained. KYP documentation is also highly tailored to individual registrants and their business models, particularly depending on the types of products and securities that are made available to clients. It is reasonably expected for registrants offering a product shelf limited to widely traded blue chip equities and ETFs that KYP not be as fulsome as when compared to exempt market products or specialized sector equities. There are no specific guidelines for what constitutes KYP. However, we would generally expect written documentation reviewing, but not limited to, the product risk, cost, liquidity, and the issuer's management, financial position, and business activities. KYP must be completed at both the registrant and the advising representative levels. The firm must review and approve the product for inclusion in client portfolios, and the representative must understand the product for suitability for the individual client's portfolio. We note that for smaller PM firms that have the same individuals conducting multiple activities, this may be completed at the same time, as a client-facing advising representative may also be the person approving the product on behalf of the registrant. While we do not expect a duplication of the KYP process, registrants must use their professional judgment to ensure that they have completed a sufficient assessment and obtained a sufficient understanding of the securities they are making available to clients. For example, PM advising representatives who are responsible for approving individual securities for inclusion in the fund or model portfolio are responsible for the KYP of the individual securities in the portfolio or fund, while a client-facing advising representative recommending the fund or model portfolio is required only to complete KYP at the fund and portfolio level. The depth of the KYP documentation required may vary depending on the nature of the securities, the client circumstances, investment objectives, and the relationship between the client and registrant. A new requirement under the CFRs is that all transferred in securities must follow a KYP process and be individually assessed and understood. We note that these transferred in securities may be a one-time investment holding with the expectation to quickly sell them and purchase a previously approved registrant product. However, each security being transferred in is subject to reasonable KYP documentation standards based on the registrant's professional judgment. However, the thoroughness of the documentation does not need to be as extensive as it is for securities that are officially on the firm shelf or held in client portfolios over the longer term. Regarding suitability, registrants are required to consider and document an assessment of the impact of an investment action on a client's account. In general, if an investment is illiquid or high risk, such as when registrants recommend some exempt market securities, the assessment must be sufficiently documented. The factors to be considered should include concentration, liquidity, and the effect of costs on the client's portfolio. Most registrants have been documenting concentration issues. However, the CFRs also require consideration of the client's ability to access funds from potentially selling or liquidating the investment and the cost paid by the client, which can reduce the investment return. It is expected that advising representatives will document the rationale of why a higher cost investment was selected when similar quality investments are available at a lower cost. Similarly, documentation is required as to why a higher cost investment was selected and how it is of benefit to the client. As part of the suitability assessment, registered individuals are required to consider a reasonable set of alternative actions, offering similar investments to the one selected or another suitable alternative, such as not recommending the investment. These alternatives should be considered and an explanation of why the investment was selected, how this investment is suitable, and how this investment action puts the client's interest first must be included in the client's notes. For similar widely traded equities, for example, blue chip stocks, an in-depth explanation of the alternatives may not be required. Additionally, some registrants were not performing a suitability assessment when the firm became aware of a material change in client circumstances or the securities in the client's account. The following suitability findings were identified at various registrants and do not involve CFR changes. A few registrants were not maintaining documentation to support their suitability assessment and did not perform suitability assessments on client-directed trades. When considering client-directed trades that are not suitable, registrants must recommend an alternative suitable investment action, which may include a recommendation to not invest in the security. If the client declines a suitable investment action, the registrant must document the decline and obtain client instructions to proceed with the unsuitable transaction. Additionally, a number of firms have not been maintaining written evidence to support permitted clients waiving KYC and suitability requirements as found in 13.31 of the National Instrument. We have identified several registrants whose policies and procedures have not been updated to include the CFR enhancements in the areas of KYC, KYP, and suitability. In one instance, we identified a firm that had updated its procedures. However, it had not documented these changes in its manual. Common findings include policies and procedures that were copied verbatim from the National Instrument and related CSA guidance, were not tailored for the operations and business model of the registrant, were high level and vague in what was required and who was required to perform the activities, did not define what a significant change in client KYC information entailed, did not define what a significant change was in securities being monitored for KYP purposes, did not identify who was responsible for approving securities being made available to clients, did not discuss how to put clients' interests first, did not explain how to define and collect client risk profile, and did not explain how to consider a reasonable range of alternative investment actions for a client when making a suitability determination. The expectation is for firms to train all appropriate staff on the CFRs and other regulatory requirements generally. This would include training all registered individuals, supervisory, compliance staff, and additional staff as may be necessary, depending on their roles and responsibilities. For example, most firms provide their staff with training on the firm's code of conduct, which generally includes training about conflicts of interest policies, procedures, and controls. Depending on the content, this may be sufficient to evidence training of staff. Specific training modules may be required for certain material CFR issues. In respect of certain staff, copies of the registrant created and tailored training materials should be kept. Registrant should exercise a professional judgment when developing and implementing training modules and determining which staff require training. And now my colleague James Steele will take us through the rest of our presentation. James.
Thank you, Ali. I will be walking through other recent findings. Through our reviews, we have found issues with regards to marketing. We found that firms were using unsubstantiated, unbalanced, or inaccurate claims. We found that firms were having the following issues regarding marketing. Performance return data, which did not disclose the appropriate time period. Third-party information with no source of information identified. Claims that lack sufficient disclosure of the risks of private equity, including disclosure of the differences in valuation frequency between public and private securities. Information presented without adequate disclosure of the significant differences between most institutional and individual investors in regard to their financial circumstances, investment objectives, time horizon, risk tolerance, liquidity needs, and knowledge. And the inappropriate use of disclaimers in various marketing materials. These disclaimers relate to the firm using third-party information that is not verified or confirmed to be accurate. We have also found the inappropriate use of trade names. Specifically, we found that firms were using trade names without at least equally prominent references to the full legal name of the registered firm. In essence, firms were not providing clear disclosure that the trade names are of the registered firm, which can be misleading and confusing to clients as to what entity they are clients of. Conflicts of interest. We found through the course of our reviews inadequate controls to address material conflicts of interest. Specifically, some firms had not made adjustments to comply with the new requirements under the CFRs. Firms were providing only disclosure of conflicts of interest without any other actions to address the material conflicts of interest in the best interest of their clients. Disclosure alone is not sufficient to address a material conflict of interest in the best interest of clients. Client consent was obtained with a material conflict of interest regarding proprietary products. However, consent without other action on the part of the registrant will not be enough to address a material conflict of interest in the best interest of a client. Registered firms are required to address all material conflicts of interest between a firm and itself, including each individual acting on its behalf, in the best interest of a client. A firm must address material conflicts of interest by either avoiding those conflicts or by using controls to mitigate those conflicts sufficiently so that the conflict has been addressed in the client's best interest. Additionally, we found that firms did not identify the conflict of interest from fee arrangements, which make certain clients more profitable than others. We also found through the course of our reviews inadequate disclosure of conflicts of interest and that disclosure provided to clients contained inaccurate or out-of-date information. Registered firms are required to disclose in writing to its clients all material conflicts of interest identified, and the disclosure must include a description of the nature and extent of the conflict of interest, the potential impact on and risk that the conflict of interest could pose to the client, and how the conflict of interest has been or will be addressed by the firm. Relationship disclosure information. Through our reviews, we have found instances where there has been inadequate disclosure to clients. Registered firms are required to deliver to a client all information that a reasonable investor would consider important about their relationship with the firm, and to take reasonable steps to notify the client in a timely manner of all significant changes to that information. We have found issues with the disclosure of the following. Custody information. Clients need to be provided disclosure of where client assets are held and a description of the risks and benefits to the client arising from those assets being held at that location and in that manner. Products and services. Firms must provide a general description of any limits on the selection of products and services the firm will offer to the client, including whether the firm will primarily or exclusively provide proprietary products to the client. Client reporting. A description of the content and frequency of account statements and report on charges and other compensation, as well as a description of the content and frequency of the annual investment performance reports. And dispute resolution services. Firms need to disclose all of the firm's obligations if the client has a complaint. Registered firms should provide clients with information about material conflicts of interest, which include relationships with related or connected issuers, competing interests of clients, compensation practices, fair allocation, and soft dollar arrangements. If a firm has determined it has no material conflicts of interest that they are required to disclose, the firm should maintain written documentation to evidence that they have considered the issue. Client reporting. We found through our reviews that clients of some firms were not provided with an applicable statement for each of their accounts. Some firms only provided reports at the household level and did not provide reports at the account level unless requested by the client. There is no provision for consolidated statements, so a registered firm is required to provide every client with an applicable statement for each of their accounts. If a client consents in writing firms can consolidate that client's account into a single report. In addition, firms may choose to provide supplementary reporting at the household level to clients. Firms may provide supplementary reporting that they think a client might find useful. For example, a firm might provide a consolidated year-end statement where a client has requested a consolidated performance report. We also found that clients were not provided with quarterly and annual statements on a timely basis. We found instances where clients received quarterly statements over 1 year after the completion of the quarter and annual statements that were never delivered to clients. Account statements, additional statements, and security position cost information must be delivered at least once every 3 months. Annual reports, reports on charges and other compensation, and investment performance reports are required to be delivered for each 12-month period, and the delivery timing is tethered to the delivery of account statements. They must be delivered combined with or accompanying account statements or within 10 days after those statements were delivered. Books and records. We found through the course of our reviews instances when records were not maintained when a switch or upgrade to a new portfolio management system occurred, specifically around client reporting. Firms need to maintain documentation and have access to the previous portfolio management systems so they can access their clients' historical positions and trades, and they can provide reporting to clients as needed. Firms are required to keep a record for 7 years from the date the record was created and in a manner that permits it to be provided to the regulator. Supervision of associate advising representatives. We found instances where there was no evidence to demonstrate that an advising representative, or AR, had pre-approved the associate advising representative, or AAR's, advice to clients. Firms must designate an AR to approve the advice provided by an AAR. The designated supervising AR is required to approve the advice before the AAR gives the advice. Portfolio manager firms that have AARs are required to document their policies and procedures for meeting the supervision and approval obligations, implement controls, maintain records, and notify the regulator of the names of the AR and AAR whose advice they are approving no later than the 7th day after the supervising AR is designated. That concludes our presentation.
All right, hello. So my name is Tanya Fleming, and I am part of our corporate finance division at the Alberta Securities Commission. So my work is with the business side rather than the registrant side. But we wanted to take a bit of time and talk to you about some of our efforts in Alberta with respect to capital raising and specifically efforts aimed at the small business community. So my team looks at private markets and innovation, so that kind of innovation ecosystem that exists here. And there's been all sorts of efforts by our government to really promote that activity. We see a lot of really cool things happening in the tech sector. And actually last year, an Edmonton-based small business, and it's not that small anymore, but the company's his name is Jobber. That was the largest deal in the province, based out of Edmonton. And, again, they weren't, this overnight success. They started as a very small company. It was, they're an app or a platform that contractors can use to do quotes, invoice clients, and really can have records of their subcontractors and their clients. And that company has just grown and grown and grown, but over a series of capital raises, but last year being the largest deal in the province. So an example of one of the small businesses that has been very, very successful here. I'm going to spend a few minutes just to talk about some foundational pieces with respect to small business. Anytime a company wants to raise capital, they have a fundamental requirement, which is the prospectus requirement. So it's one of the requirements in the Securities Act. You must issue a prospectus, and the idea behind that is that investors need timely, accurate, comprehensive information in order to make investment decisions. A prospectus is it's a big document. It takes a lot of time to prepare it. It's quite expensive. It goes through an extensive review process at the commission. We receipt it prior to the company being able to then issue those securities. It's a lot, and if you're a small business and you're raising not a lot of capital, it does not make sense to do a prospectus. It's just too much money. So we have then the or. So you have to issue a prospectus, or you have to fit within a prospectus exemption. Now, most of our prospectus exemptions don't allow a business to raise money from the public. So there's only a few exemptions that actually let businesses raise money from the public. And you'll be familiar with some of them. But this small business financing exemption that I'm going to talk about today, which is one of our new initiatives, it's one of the ones that can actually be used by a small business. So again, this is the starting point. It's the prospectus, too high of a cost for very small businesses. But there's always this balance that we're trying to achieve, and it's that investor protection and fostering an efficient economy. We want to see these businesses thrive and grow, and we're very aware of the costs that are associated with capital raising. So we come into, okay, what does this look like, this exempt market, prospectus exempt market? So what are the ways you can raise capital without doing that prospectus? And of course, the rationale for the exemptions, a variety of things depending on the exemption, but if you're rich enough, so accredited investor is of course by far the most commonly used prospectus exemption. So these are individuals that there's a number of criteria to be an accredited investor, but for individuals, it's commonly an income or a liquid asset test. They have a relationship of trust with the founders of the company, so they know them well enough that if they need information, they can ask. Or perhaps there is disclosure available, but it's a prospectus light, so it's not the full version that you'd find in a prospectus. It's something less, but there is in fact some disclosure available, and or only a small amount of money is at risk. So again, that's an investor protection mechanisms. We often will let people who are, they want to get in on this. They don't meet the tests that are there that currently, that often centered around income. But they're only putting a small amount of money at risk. But those prospectus exemptions are really quite narrow, and they are technical, and you have to comply with the requirements for that particular exemption. And you can a business can use more than one exemption at a time. So, you could, when you're raising capital, you could have some money from accredited investors, and you could have some other money from friends and family, and then you can also use a small business exemption for some other investors. So there's a way to bring it all together and help that business raise money depending on who their investors are. Most of the exemptions are in one instrument, which is 45106, but we also have some other exemptions that stand outside of that. Crowdfunding is an example. Crowdfunding, you'll be familiar with, you're raising through a platform. So if you've ever looked at some of the crowdfunding platforms, it's very exciting. They're marketed really well. Front Funder is probably one of the biggest, they probably do the most crowdfunding raises, but if you go to their website and you look at opportunities available, you can only invest very small amounts of money, but they're really marketed well, and they are aimed at the public. And then we have a number of things that are ASC specific, because as I mentioned, we have really tried in Alberta to be very friendly to small business. We'd like to see that segment of the market be able to raise capital while we balance investor protection. And on some of these, we're working to harmonize them with other jurisdictions, and very often Saskatchewan will come along with us. So for example, 45539, the small business financing exemption, is one of the ones where Saskatchewan has joined with us on this particular initiative. These are some of the the common 45106 exemptions, and some of these you'll probably be familiar with. Offering memorandum is probably one you're quite familiar with. You may well have products that are on your shelf that came about via an offering memorandum. And like a prospectus, it's quite a comprehensive disclosure document. And actually the OMs have gotten more and more comprehensive over time. And as a result, they're also more and more costly to prepare. There's investment limits on them, but because this is one of our exemptions where if there's a registrant that's involved, that registrant is a gatekeeper. So this is money from the public, but there's someone who's involved, and to the effect that they're making a suitability assessment, we have increased the investor limit. So this is one of those examples where when a registrant is involved, it changes the risk. I mean, the risk to the investor changes because of the involvement of a registrant. So that's one of the examples. And of course, we introduced the concept of an eligible investor is introduced in this particular exemption. So this is a lower financial threshold than someone who would be an accredited investor. And we've talked a lot about compliance, my colleagues just before me. When it comes to complying with prospectus exemptions, the obligation is on the issuer. And that is something that a lot of small businesses don't realize that. They don't actually realize that the obligation for compliance, when they're talking about raising money, it's them. It's not the investor. It's not their lawyer. It's them. So when it comes to complying, making sure they comply, it's important for the business who's actually doing the raise to have an understanding of what the requirements are. They need to make sure, for example, that the investor is eligible to invest. So if a business is using the accredited investor exemption, the obligation is on them to actually ensure that the people who are investing are in fact meet that test of being an accredited investor. And so the business has some reasonable steps that they would need to take in order to verify. And of course, as you know, when it's an exempt market offering, there's a resale restriction that's attached to it. These are securities of private companies. They're not liquid, they're not trading, and very often, once you're in, it's pretty hard to get out. So you have to have, in fact, another prospectus exemption in order to resell that security. So that's always a consideration for investors, and making sure your investors, and if you're a business, when you sell those securities, making sure your investors do understand that these aren't liquid securities, and in order to resell them, the typical resale market is typically an accredited investor, someone who would be eligible, in fact, to purchase those securities. Another thing to know about that isn't always well understood is that for a business, they have to comply with securities law both in the jurisdiction they exist in and also where their purchasers are. So if you're selling securities, you're an Alberta-based business, but you're selling to someone in Ontario, securities law is, of course, provincial. We don't have national securities law. And there are often differences between the jurisdictions. So for a business that is looking to attract money from outside of its home province, they do have to make an assessment. Can I actually, in fact, can I take an investment from someone in Quebec? Because in order to do that, I need to comply with the law of that jurisdiction as well. For a lot of small businesses, especially when they're first starting out, they'll be raising money in Alberta. So for some of our recent initiatives that we've looked at, I mean, that's all we can do. We can only for us at the ASC, we can actually only make law in Alberta. So we can say you can take money from someone who is, as an Alberta business, you can take this money from an Alberta resident under this particular exemption. And then again, sometimes Saskatchewan will come along with us, so you can then take money from someone who's in Alberta or Saskatchewan. So specifically, this blanket order, and I'll just foreshadow a bit. This is a relatively new exemption, but it just came off of its trial period. So we have extended it, but we are very much looking at making some changes to it. So to the extent that you have thoughts or comments as I'm walking through it, I'm going to walk through it is as it is right now. But to the extent that you think, oh, it would be better if, and you'd like to just do a quick coffee or a Teams call and just share those with me, I would be appreciative of that and interested in hearing your feedback. Because one of the things is people, come out with these exemptions. Sometimes when we first come out with them, they're kind of quite complex, and people say, this is just too much work. I just have to learn it all or develop all the forms. It's just too much, and I'm not going to use it. And so sometimes after a period of time, we in fact get that feedback from the market, and then we have a relook at it and perhaps simplify it or make some changes to it. So that's some foreshadowing. And again, if you're interested in doing a consultation, pass on your contact information to me or any of my colleagues, and would love to do that. So with this particular exemption, this is an exemption that can be used to raise money from the public. So the business doesn't need to have a relationship with purchasers, and that's similar to crowdfunding in that the business can actually advertise, I am looking for money for my business, and I can take money from you even though you aren't my neighbor, you're not my, good friend from high school. But unlike crowdfunding, the business can interact directly with the purchasers, so there's no need for it to go through a funding portal, where there is that third party that's involved. The business can also use a registered dealer to assist them in raising funds. For this and other exemptions, we do often say if there's a dealer involved, then the investment limits are higher. So the offering memorandum is a good example where we have a cap of $100,000 if there's a suitability assessment. So a greater amount of money is involved if there's a dealer because of that investor protection mechanism that's built into it. With this one, there's a prescribed offering document, so it's similar to a prospectus or an offering memorandum, but this is the light version of that disclosure. And again, a lot of feedback we hear is the securities lawyers, it's just too much work. These new exemptions, they're like, I don't know, we'd have to develop the templates and have to get familiar with it. And, these small businesses, they're not big billers. Like their bill can't absorb a lot of fees. So the security lawyers are actually quite reluctant to use some of the new exemptions because of the work involved in setting up the new forms. So with this one, we actually went and we made a fillable form. It's in Word format, and you just download it on the ASC website, and it has all the fields, and you just fill it in. The whole idea that it is, well, first of all, you can't vary it. So if you don't like our formatting, is not like the best, it's not the prettiest looking document, but it is what it is. You can't vary it. And you can't delete anything or change anything. And you just go through and you fill out those fields. So it makes it really quite easy. And the business can do that work themselves. So there's an instruction document that comes with it, and this is something, again, to save costs, because everybody knows legal services are very expensive. At the end of the day, you probably still need the assistance of your lawyer to actually go through the whole funding process and close your transaction, issue those securities. But if the business can do some of the work themselves, obviously the bills are going to be lower. So this is I think very, very helpful to the small businesses to be able to do that. The document has to be provided to the prospective purchaser before they actually sign a subscription agreement, so they see the information about the business they're planning to invest in before they actually sign up to buy it. And always, to the extent that there's forward-looking information in the document, which there probably will be, because so many of the small businesses, it's not an established business. It's very often, it's often tech-related. They've got cool technology, maybe it's developed out of a university, but they don't have an established business yet. So there is likely forward-looking information that is in that document. And the businesses has to be very careful anytime you make forward-looking statements, just to be sure that there is that advisory language. You provide the assumptions on which that information is based. And it can't contain a misrepresentation. Misrepresentation is, an untrue statement, but it's also an omission to state something that would be required. And that's something that, again, the founder of the business is very excited about what they're doing, and they believe in this, and they need the money to develop their product. So, they have to be very careful, and if you're interacting with them potentially as a dealer, just really being sure that that document contains the material information, doesn't miss anything, sets out the risks, more disclosure, the things that could go wrong, it's just put it in there. Put it in. You don't want to have a misrep. For this particular exemption, as I mentioned, the head office of the business has to be in Alberta or Saskatchewan. We also have a requirement that the majority of the directors and officers have to be in Canada. So this is Canadian small business that we're really looking at. And it has to be a private company. It can't be a reporting issuer, and it can't be an investment fund in order to use this exemption. The limits on this particular exemption are very low, and perhaps too low. This is a lifetime limit of raising $5 million with this particular exemption. And that might be something that, people tell us is just, not going to get a lot of use with that small of a limit, perhaps. And we also limit it annually to $1.5 million, or you can raise actually up to the full $5 million in 1 year if you're providing financial statements. We also, again, we have investor limits. So how much can the purchaser buy? And those are higher to the extent that there is a dealer involved. There's also 2 levels here. So to the extent that the business has financial statements, they can provide them, but they don't have to. So you can actually do a raise without providing any financial statements, but there's a lower investment limit provided there. If the business does have financial statement and wants to do it, we are allowing them to use reviewed rather than audited financial statements. It's no surprise, but the cost of having audited financial statements, it's very high. It's a lot of money, and especially for small business that's just trying to get off the ground. We're really thinking about burden reduction for them in terms of the regulatory requirements, while balancing investor protection. So reviewed rather than audited financial statements are allowed in this one. And if financial statements are provided, there's a requirement to provide them for 3 years following the date of the distribution to the investors and to the Securities Commission. But that's a 3-year cap. So that's unlike the offering memorandum exemption, which the small businesses have really shied away from, because the offering memorandum exemption has an indefinite period of time in which you have to provide financial statements. And with the offering memorandum, they're audited financial statements. So there's a significantly higher cost associated with use of that particular exemption rather than this one. So again, this is really aimed at that smaller business community. And of course, we have a risk acknowledgement that must be signed and maintained by the business. Your classic, this is risky, don't invest in this unless you can afford to lose all the money you pay for it. Small business investing is risky. Everybody knows that. Lots and lots of these businesses will, in fact, fail. And if you're investing in this community, that's just something that you have to know. I mean, you're looking for the jobbers, you're looking for those businesses that are really, scrappy and just keep getting their money and keep growing. But sometimes the founders, they're amazing engineers, scientists, but capital raising is just, they just can't do it. So sometimes the business will, in fact, fail. With the initial founders, and then sometimes it gets picked up again by somebody else. That technology gets picked up and goes from there. But it's just the reality of this particular group of businesses and small business founders is many of these businesses do in fact fail. With the exemption, there is a cancellation right. So if somebody gets, talked into it, they go to a pitch competition at Edmonton Unlimited. They're so excited. They're like, I can't even wait to sign up. And then they go home and they tell their wife, and their wife is like, yeah, it's like nice, except that we need that money to, whatever, buy a new stroller. They can change their mind and the money must be returned. So hence another reason why there's very often a lawyer involved at this part of the transaction, where the money is actually in the lawyer's trust account and can be returned if in fact the person does change their mind. And then, as I mentioned, also there is also liability for misrepresentations with this exemption. There's a max marketing period as well, so it's a 120-day marketing period, and if something material changes during that time, the offering document does have to be updated. And if there is, at the end of the day, a misrep, there's the right for investors to sue. And they're not just suing the company, they're suing the directors, they're suing the officers, which, can be devastating for these founders. So no matter how excited they are, how awesome they think this business is going to be, again, just this very caution on making sure there's not a misrep in their offering document. And there's filings due with us, but unlike most of the time, there's an obligation to file within 10 days. We have extended that to 30 days with this particular exemption, again, just to try to make it a bit easier for these smaller businesses. They're filing a report of exempt distribution. They're filing their offering document with us. And if they used financial statements to raise the funds, those are also filed. And my team reviews those, and we love seeing the use of these small business exemptions. So when we do have materials come in that's relating to these small business ones, we do look at them. There's usually always compliance issues. They're not quite right. If they use the form on our website, that's usually pretty good. But we take a very educational tone. And we'll just have a call with the business, and to the extent that something's like the report of exempt distribution, that's never right. There's always problems with that. But we just help them fix it, and they refile it and go from there. So we take a very educational tone with this market to help them get familiar with the process of raising capital and complying with securities laws.